Good morning, friends. Hello, everyone. Welcome to the stream. Mic check. Looks like everything is good. We are live. We are connected. There are people in the chat. Let's do it. Hello. Hello. Welcome, friends, to Alpha Beta Soup. I'm TXMC. And here we are live. It's March 21st, 2024. I don't even know what day of the week it is. It's Thursday. Welcome in, everyone. Let me close the door to my office. I totally forgot to do that. Allow me to secure the acoustics for this broadcast. One moment. All right. Glad to see everyone. Sorry we missed you last week. I'm a dad, I'm a family man. It was spring break. I thought I would be able to get in a live stream in addition to a bunch of other things that I had crammed into the end of the week, and I had to cancel it like at the last minute. And so I apologize for that. But here we are. We're going to keep going. There was no big emergency, just a lot of things all kind of culminated at once, and I didn't manage my time well. Today, we'll take a look at Bitcoin, we'll look around the crypto space, and we'll spend some time talking about the FOMC from yesterday. I've got some opinions about that. We'll talk about what Powell said, the tone coming out of that meeting, what it seems like the market's read on that is, and we'll talk about all those things. I'll try to keep today's broadcast focused on those two things. I don't want to get way off into the weeds talking about China, way off looking at a bunch of other esoteric data and stuff unless it's relevant to what we're talking about today. And if we have a lot of things that are still on the plate that we need to discuss, I'd rather just do another stream, maybe in like a few days, maybe on Sunday or Monday, and just do another one again if that's what we need to do, rather than continually having you guys sit through 2 hour long streams. I've got to get better at that. So we're going to keep it to a couple of topics today, but very prescient topics. The BTC action has been a little lackluster. Crypto action has been a little lackluster the last few days, ever since BTC pulled back from the all-time high. And we're kind of just waiting to find out the outcome of this consolidation here below the previous all-time high. This yellow line is the all-time high from all the way back here in 2021. And this action is what we've seen before in prior breakouts. I was a little quick on the gun when we initially broke out and pulled back over here, initially thinking this isn't quite like the other breakouts. And I should have given a little more time to play out before I felt that, because this actually looks quite a bit like 2017. And so when you go look at 2017 and you look at March of 2017, this was the previous all-time high from the 2013 cycle before. And as it approached to that on the initial break, you see it hasn't broken it yet. On the initial break, it pushes, and in the high wick, it gets about 7% above the previous all-time high, but then through a series of different legs, it makes its way to a 30% drawdown, 28.4 on this particular one, but call it 30. And then we turned around, and about 25, 26 days later, we were back above the prior all-time high, and we never looked back. But there was that initial 7%, 8% push, a 28 to 30% drawdown, and then another month or so before we got out of there. Well, lo and behold, we have pushed above the prior all-time high by 7%, and we're now back below it. If we get a similar drawdown, if history is bound to repeat itself, which there's no requirement that it should, but if we're going to use that frame of reference, that would take us down to about 50, 49.50. It would be basically this, you could call it this structure right here. Would essentially, where's my drawing tools? It'd basically be this if we did something similar. Maybe we will, maybe we won't. I don't know. Maybe this was the low. Maybe this little bounce right here that we just got yesterday or day before, maybe this is the low. I'm not sure. Maybe we just take out this wick, or we put in a full leg down and then turn around. All of those scenarios are possible, and us to can still continue higher. Certainly plausible. I am leaning towards thinking that if this is the actual cycle high, it hasn't fully convinced me of that yet, because we haven't really seen a kind of blow off of energy around it. I mean, it was pretty hyped on this move here, but I think we'll go over some of that today. I don't want to get ahead of myself, but if this is just a cycle high, just like this, we're just going to roll over here at the previous all-time high. Maybe we do, but it's just too early to call that. But we've got some mixed messaging in the data. We'll look at a couple of things here on the stream today. But so far, the main takeaway that I had, the main takeaway from this was just that this did look like the prior cycle here in terms of the push up, and maybe we're starting to put in a drawdown. Maybe it gets back down into the low 50s. Not really sure. I'm still, just kind of observing this. I'm just a spot holder of Bitcoin, but its action will guide the action in crypto broadly. If it gets a bigger pullback down into here, kind of depending on what drives it and how quickly it does that, I think would influence the likelihood of a big retrace in the rest of crypto. We're seeing some movement there, though. There is action. It's not just a bleed over in crypto land. A lot of alts are moving. We've got a few of the RWA tokens that are ripping. We had some L1s ripping. The meme craze seems to be cooling just a little bit for right now, maybe taking a breath and letting some other things run. But I wanted to show some of this. I wanted to look at this on this chart. This is expanding this is a look at the rest of crypto. Sorry, my thoughts are a little jumbled here. We see BTC, we see where it is. It's right below the prior all-time high. We're just kind of chopping around in this range. But for the rest of the crypto market, I've been trying to observe what I think the health of it is in terms of this leg of this rally here. And I just found a couple of interesting things that I wanted to share. So we looked at some of this in the prior stream, and I tweeted about a bit of this, but I wanted to expand on it some here because I just think it's really interesting information. And this is market breadth for crypto, right? It's like a MACD for crypto names advancing versus declining. So when you see this rising, it's showing that coins inside of crypto are broadly making new highs as opposed to making new lows. And as it continues to rise, that number is growing. And then when you see the momentum break down, that trend is starting to reverse itself. You can, of course, still see new highs while breadth is thinning. That's the same thing we've seen in the stock market many different times throughout the last year and a half. Are periods where there's very thin leadership, but because of the makeup of the index and because larger caps can move things, we've seen the stock market rise even while many other names inside of the index struggle to keep up. But we can see something like that here in crypto. And if I go down, let's look at this on like an 8-hour chart. I want to point this out because I want to kind of keep it in mind for myself the next time I see a big leg up in Bitcoin and the rest of the market, to watch this a bit more closely. I saw this developing, but I didn't say anything about it until it had really manifested. And the thing that I noticed was, as we see the crypto market pushing up and making new highs here, this is total 2 minus stable coins. So it's everything except Bitcoin and stable coins. And as you can see, it pressing new highs on the wicks each day. We're seeing a rollover in momentum right up here near the peak, but it's actually starting to slow. You see these green bars, they're getting smaller and smaller. So the rate of change of the shorter term moving average is starting to slow down. And on this push, where's my box? Cast your eyes down to here. Let's take off the background. Let's make this bright yellow like this. This represents the health of all of the names inside of this group of cryptos. This is like the top 40 coins. I'd like to do the top 100 coins, but TradingView won't let me put that many coins in a single indicator. So this is the top 40, not the stables, just cryptos. And inside of here is the dispersion of the daily change of all of these things. So this is like a moving average of how many are going up versus how many are going down. Inside of here, these candles represent the daily change of all of the different symbols in this group. So the high wick is the highest daily change of any single name in there. The bottom wick is the lowest daily change. When you've got a big candle that encompasses a long range, you've got a bunch of cryptos moving at a bunch of different percentages, right? Something might be up 60%, something's up 10%, something else is down 5%. You get this massive candle. And what I noticed was, as this is pushing higher, at first you see a lot of blue, right? Just this first part here. Let me turn off these dots. You see a lot of blue. And you see the wicks expanding higher and higher into the rally. That is showing that more and more coins are participating. Every day we're having more advancers than decliners. Momentum is rising, and the gains are getting better too. You see the wicks rising and the bodies of the candles expanding. So everybody's kind of joining in on this party here. But then once we got to this area, right around the day of that really nasty flush in early March 5th, right around that point, we started to see more red appearing here in the dispersion, even though we saw the momentum continuing to rise, granted slowing, but still positive, and new highs on the actual prices, right? Like on the actual cap of total crypto, it was still rising, but fewer and fewer names were participating. We had some names that were having minus 10% days in the middle of this, getting pushed up here. And then once we rolled over, it really, the whole thing came apart. And so you can see how the health inside crypto really started weakening up as we pushed into these highs, as opposed to the early part of the rally here where it was all blue, right? We start seeing more decliners, the gains start falling, the wicks are getting lower, and we have more dips down into the red. And if you go down to like an 8-hour time frame, you can really see where that momentum breaks. So here's where we drew our box on the daily, and you can really see where that momentum started to break down right here. You see that? Even though we continued to make these highs, here was that flush on the 5th, and then we recovered from it, and we kept pushing higher for a couple more days, a few more days, maybe a week. But during that period, you could see momentum just slowing until it finally broke down at the high. So that's a dynamic I want to pay attention to. I'm saying this for myself and also because I need to show it to you guys as we're watching these things unfold. But if we get another leg up here, another part of this move, if the bull market continues from here, that's something that I think I'll be paying close attention to look for health inside of there as a sign that we're getting near the end of that leg. We take a moment, catch up with the chat rather than talking for 45 minutes before I do that. Wow, before the stream even started today, David Kyra gifted 5 memberships to Alpha Beta Soup viewers. Thank you so much, brother. You're an OG donor to the memberships here. I see Trader XO in the chat. Welcome, my brother. Good friend of mine. What else did we have? Oh yeah, did I miss anything else in the chat before we started? No, it was just David with gifting those memberships. Thank you very much. All of you who were gifted from David, Blockproof, Oscar Santana, Michael Walters, you guys, next time we do a member stream, which will probably be in 2 or 3 weeks, 2 weeks probably, you will have access to that. So we've been doing those once a month. We do a private stream for all the homies after we do the public stream every about 4 streams or so. We did the last one 2 weeks ago. So I guess in another week or 2, we'll do again and do it again. And if you have a green name, you'll be able to join it. So anyway, crypto breadth was weakening on the move up, but structurally, just as because we kind of look around, we haven't just seen a complete obliteration of market structure, right? This low still held here on total 2, and it also held on Bitcoin. It looks the same as BTC. It broke it on ETH, but then recovered, right? If we look on ETH here, oh, why is that black? We had these equal lows. We tested all of that. We bounced back up. And this was some Gary FUD. So there was some FUD yesterday about how the SEC is going to be charging the Ethereum Foundation and trying to prove that ETH is a security. It was just a bunch of ETH FUD. And it was perfectly timed like at the exact moment when everyone was wondering if we were going to go deeper or if structure was going to hold. We broke some structure here on ETH, and maybe we're putting in a lower high. But a lot of times, moments like that where we have intense FUD, but you still see structure holding on other names, and many other alts also put in a higher low rather than a lower low. When you see moments like that, a lot of times they can mark a reversal or at least mark the floor for a period of time. So it's yet to be seen. ETH has been just remarkably weak during this whole move, this whole run. It had like a week where it looked like it was catching up at hyperspeed, and then just resumed being a flaccid penis once more. And so it's not surprising to see it break down here and to show some weakness. It doesn't really have any narratives. All of the memeing is happening on Solana, and Bitcoin has the ETFs narrative. So Ethereum's just kind of floating in no man's land right now, and its price action reflects that. But alas, not everything looks like that. More names look like this. And so I'm interested to just kind of see, like, here's Solana, right? Higher lows. So I'm interested to see where we go here. I did think that we were getting a little overheated. I'll show you a chart here in a second that reinforces some of that from an on-chain perspective. But I don't know how low that means we have to go here. I know a lot of people are waiting to buy lower, but as we've seen repeatedly through this cycle, people that wait to buy lower don't really get a lot of opportunities. So perhaps that trend continues, and perhaps this low is just another higher low in the sequence of higher lows. We'll see. But I mentioned Ethereum and its weakness, right? I want to show you guys something. So we looked at some of this in the prior stream, but I'm going to bring it back up. So this is crypto dominance. Purple is Ethereum, yellow is Bitcoin, and red is all other altcoins. We've left stables. They have their own group. They're here, this light blue line. We're just going to ignore the stable coins. But this is the dominance of these three groups, and it's indexed to the flush on March 5th, which is this wick right here. So from this moment, what has crypto been doing? How have the rotations been taking place inside the market? So if we index this to 100 over here, this white line is break even. So what you can see is since that moment, Bitcoin dominance is down about 2% from 100 to 98, but it's been flat. It has been flat, right? An initial loss of dominance and then flat. Ethereum initially benefited, relatively speaking, benefited by the recovery on March 5th and 6th from the bounce. It initially benefited by some of the rotation, but that didn't last very long. And it has been bleeding out in relative terms ever since then, since about March 7th or 8th. And it's now lost more dominance than Bitcoin has, even though Bitcoin really led the flush. Like BTC led this movement here by pushing up into its all-time high and kind of triggering a bunch of liquidations. But Ethereum is the one that has taken it on the chin. You can see the rotation into alts. Alts have really benefited, even though they have also kind of flatlined at the level that they're at, about 10% gain relatively of market dominance since, about a week ago. But Ethereum really took it on the chin. It has been recovering some here, but I just, this is indicative. This here is another kind of feather in the cap of the idea that maybe ETH taking out this low here is as bad as it gets for ETH. I'm not really sure, but when you see this kind of weakness, maybe it holds up if the rest of the market holds up, because Ethereum's just continuing to play out the same weakness that it's been demonstrating for almost 3 weeks now. It's really been demonstrating it at multiple points throughout this cycle, but just in the most recent period here, it's really been eating shit relative to its other crypto brethren. Yeah, we'll touch on stocks a little bit. We'll touch on them. They have been mooning, and part of it has to do with the FOMC, which I'll get to here in just a minute. We've got the S&P back at all-time highs. I think NASDAQ is there. The Dow Jones is there. And I know we've talked about the 4.236, and I expressed how I'm not going to use it as some like hard line in the sand where when an index hits that level, you sell everything and you close your eyes. But I do think it means that we're very near the high of the cycle and that it's likely it will struggle to gain much further beyond that. But then we have days like yesterday that make me question myself, right? They make me question myself because the authorities are flagrantly juicing the economy into what feels like a secular blow-off. And we're seeing risk assets respond, right? Gold was responding yesterday. It's kind of choppy today, but it was pushing higher yesterday, made another all-time high. Maybe it's turning the prior all-time high from December into support now. We'll see. But responding to some of the YOLO inflation tone coming out of the Fed. And it's no surprise that we see the NASDAQ pushing up. Let's go check on the Mag 7 today. NVIDIA looking to recover. I had been wondering if NVIDIA was just putting in a lower high. Still yet to be determined, but it looks like it wants to recover here now at the 618. And this has really been leading the charge. If NVIDIA is going to keep going, the market's likely going to keep going because this will guide the action. Whereas, if this runs out of steam, which I'm not calling for it to do this, but if this rolls over, it's going to take equities with it. So I've been really watching this closely. We've kind of got this wedge forming, but we're right here at these key retracements. And with what happened yesterday, it seems like there's air cover for the rally to continue forward. And I welcome that as someone who is long risk assets, but as someone who has been studying business cycles for the last year, 18 months, I've seen too much. And these scenarios don't end well. Like we're going to, if this is the beginning of the blow off leg of the secular bull, and I was wrong about things running out of steam around where we are now, and we actually have a whole other leg to go. If that's true, which is possible, then this has a very likely likelihood of having a very poor outcome, because if you study past cycles, it starts to look like very few examples in history. It really starts to look like 1929. It starts looking like Japan in 1989. Like there's very few examples, right, that you can pull from. And so we will see. We'll see what happens. But the message out of the Fed yesterday was, we have to think back. I'm trying to think about how to phrase this. I've been racking my brain for the last 20 hours or so. Like, man, how the fuck am I going to talk about this tomorrow? Because there's so many ways we could take this. And where we are now, we're at a place where inflation is at 3%. It's been hovering at 3% since June of last year, when I said that we were at peak disinflation. That turned out to be true. I also thought this would be a period of time where we were at peak soft landing narrative. Well, I was wrong about that part. That has continued. But inflation has hung out right at 3%. This red line represents the Fed's mandate. And what it feels like is that for the first 18 months of this saga, Jerome Powell was allowed to do a Paul Volcker impression. He was allowed to try to slay the dragon for his own generation. And he did a lot of tough talk. There was a lot of scary, comparisons to Paul Volcker and what happened in the 1980s. Powell was even seen carrying around Volcker's autobiography called Keeping at It. And he even referenced that name in some of his own words in FOMC press conferences in 2022, saying things such as, "We will keep at it until the job is done." And literally the words from the cover of Volcker's autobiography. And you could tell he was channeling a certain feeling. But once we got to Q4 of last year, it became apparent that, to me at least, from my perspective, that his active role in this saga is likely over. And it's now about the fiscal situation. And we'd already started to see that developing last year when we had the debt ceiling situation in the first half of the year. And then suddenly Yellen starts slamming us with massive borrowings, but due to all of the various tools at their disposal, all of the different liquidity facilities they have and levers they can pull, the combination of Yellen and Powell's efforts kept liquidity fairly supportive, and we didn't really feel those effects of all of that borrowing coming to market like people had feared. And it became obvious that despite the Fed trying to appear tight and give the appearance that they are attacking inflation and continuing to talk tough about tightening financial conditions, it became obvious that that Yellen and the Treasury were both capable and absolutely willing to subvert all of those efforts to, reach their own ends, right? To fund the government and to keep lipstick on the pig as we approach a re-election year for her boss, Joe Biden, for Yellen's boss. And so once we got to Q4 and the market started rallying on a surprise, slightly lower amount of duration out of the Treasury and Janet Yellen, and then we had the December FOMC where Powell was like, hey, all the hikes are over. Things are looking great, fam. And he just seemed positively giddy. I even used those words, if I recall correctly. I think I even said, sorry, I got a hiccup there. I think I even said that he sounds giddy. Powell is really juicing the fuck out of this. He's positively giddy, I said, on December 13th. And we've been mooning since then. And with so much rate insensitivity in the economy, it's clear we have rate insensitivity, right? Because of everything we did in COVID, because we dumped a bunch of money on everyone, we pushed rates back down to zero, households and businesses termed out their liabilities far into the future, and then when the Fed started raising, they were shielded from much of those effects. We've talked about that ad nauseum here. We've unpacked the rate insensitivity of the mortgage market and how everyone refinanced in 20 and 21 and how they're unlikely to be sellers here. We've talked about how businesses have termed out their debts and how they are now doing everything possible to avoid paying the current cost of capital. And in many cases, they're not being required to because private credit is happy to swoop in and offer them exotic deals and covenants and things that allow them to continue to operate, even though Fed funds is at 5.5%. And for many businesses, that is an unattainable cost of capital. But regardless, we've seen all this rate insensitivity. The Fed has continued to raise, but the economy is strong. Labor has remained incredibly tight because of generational demographic changes. And now we've gotten CPI down to 3%. And so the question becomes, is the administration, and I will lump in the Federal Reserve with the administration, they are an independent body as long as Washington allows them to be an independent body. And so the question becomes, is the administration willing to sacrifice the current Goldilocks economy to make this blue line reach the red line? Is that something they are actually willing to do? Oh, that's yellow. Are they actually willing to sacrifice everything to close this gap right here? This line is 2%, by the way. And it seems that the answer is no. No, they're not. And it comes back to what Powell was saying yesterday, right? So let's go through some of the data. Let's look at some of this. I closed one of my, there we go. Let's look at some of this. So here's the summary of economic projections. This comes out every 3 months. This came out in December, and we just got a new one yesterday. It's based on a survey of all of the Fed governors, and they come up with a median forecast, so to speak, a median opinion of what all of these metrics are going to be. The top row is the current number, and the number right below it is what it was in December. I've highlighted all the numbers that have changed since December. So recall that in December, when they released the SEP, this thing they projected through this Fed funds rate figure about 75 basis points worth of cuts. 4.6 Fed funds, down from 5.5 where it is now. And so that loosely equates to 3 cuts. But the 5.25 to 5.5 is where we are now. But here we got the new projections, right? They have raised their growth forecast from 1.4 to 2.1 in 2024. What is that? That's 50%. That's another 0.7 on top of the 1.4. So they raised their growth expectations for this year by 50%. They raised them next year, and they raised them in 2026. They lowered their unemployment expectations. So they expect a hotter economy, and they expect slightly better unemployment than even they had projected 3 months ago. And unemployment right now is 3.9, by the way. It's barely below that figure. They slightly raised their inflation forecast for next year. They kept it this year the same for PCE. But for core, they raised it this year. So what is all this on net? On net, they say growth will be stronger. This year, it'll be stronger by 50% from what we thought it would be, relative to what we thought it would be. We think unemployment will be tighter. We think inflation will be higher. And oh, by the way, we are still going to cut the same amount of interest rates. That was the YOLO into inflationary growth that I'm talking about. That is them saying this gap is okay with us. In my opinion, from my perspective, they're saying the gap between this. Can I turn off these tooltips? The gap between the red line and the blue line is they're willing to eat that. And I think that is remarkable, frankly, to play with that kind of dynamic. And when you listen to Powell during the press conference yesterday, he repeatedly made mention of how the market believes that inflation is coming down. The market believes in the Fed's commitment to getting inflation down. He also, which those things are highly debatable. The credibility of the Fed is a very fluid and debatable concept, depending on who you ask and which part of the market they hang out in, that you'll get a very different answer. But he said things that were conflicting, right? So I'm going to read a tweet that I wrote yesterday right after I watched it. And then I'll add some dialogue because this will help me get my thoughts together. Where was it? Oh, okay. Let me go find it. Sorry, guys. Where did I put it? Here we go. As I heard Powell repeatedly say that they'd get inflation to target, quote, over time. That was another one. He kept saying that we will get to inflation to target over time. And before I read this, and what I think is interesting about that is they pushed up their inflation target. And if you look at this, it's showing PCE being above target. Remember, their target's 2% all the way through 2025. And if that's the case, that will have been 5 consecutive years of inflation above their target. And they're still talking as if they've achieved victory. So that was one of the things that just did not sit with my brain when I was listening yesterday to the FOMC. And I was thinking about all these dynamics, how they show in inflation, one of their fucking mandates, being above target through next year. And I only have the CPI up here rather than the PCE, but you can see it's been above the red line since early 2021. So if that goes through the end of next year, that will have been 5 full years of them having inflation out, essentially out of their control. And it seems that they're willing to live with that. As I heard Powell repeatedly say, they'd get inflation to target, quote, over time. When, dude? And dismiss rising inflationary data while saying that he didn't like picking and choosing data, I couldn't help but sense that the man is totally checked out. As if he feels the hard part is whipped. His legacy is written, and he's just going to let shit ride till he can retire in 2026. Growth is up, inflation up, employment is full. Rate cuts anyway. Fuck it, we ball. The next baboon they put in the chair can deal with the fallout. That was just a feeling I got yesterday. And I'm being a little sarcastic when I say it this way, but I followed up my saying that with, I'm being provocative, but what's apparent from my perspective is that the curtains are beginning to draw upon this era of Fed independence that we are in right now. Powell spent the first 18 months of this saga slaying the dragon, the inflation dragon. But the heavy lifting is done, and the show must go on. We already see divergent paths between the Fed and the Treasury, as I was just talking about, which can only deepen as the authorities try to steer a massive economic barge around the debt trap singularity. Because if you look at the projections from the Congressional Budget Office, they show deficits rising up to like 10%, basically from their own momentum, even without Fed funds being at 5%, largely because of unfunded liabilities to the entitlement programs. Whichever administration enters next year, deficits are likely to remain outsized into the foreseeable sunset. The only palatable path to fixing the debt to GDP fraction is by mooning the denominator, by mooning the GDP. That means negative real rates at some point. The Fed is still allowed the appearance of independence for now, but those days are likely numbered, and Powell probably doesn't want to be around when the charade ends. Those are just my opinions, but we have history, we have precedent for these things. We've got Powell. He's been in the chair since 2018. You know, he started off in a kind of unflattering way with the repo blow up 18 months into his tenure. But he navigated us through COVID, which he is due ample criticism for many of the mistakes that he's made. However, he got us back to having a strong economy post-COVID. We didn't have a prolonged recession, and it's possible that he's navigating us into a soft landing here in 2024. Yet to be seen, but some data points to that. But that is going to be his legacy, and he's done that by being allowed to kind of run the ship the way he wants, at least in this administration, without Trump in office yelling at him to cut rates all the time. He's been able to fight inflation essentially the way that he wants to, though he has not been given fiscal support for inflation, which is something that Paul Volcker did have. So when Volcker raised rates in 1981 to fight the to send us into the second recession, after Carter had left office, it was right when Reagan had come in, and Reagan actually supported Paul Volcker's efforts because Reagan was trying to rein in government spending, and he was all about austerity when he first showed up and government responsibility. He changed his tone later on in his administration, but in that first year or two, he gave Paul Volcker the fiscal air cover to run tight monetary and to see its effects manifest. But this administration has not done that. They've allowed Powell to pretend like he's Paul Volcker, to slay his own dragon, but they've continued to run massive deficits. We've been running 7% full employment deficits nonstop since COVID. And it doesn't seem like there's any appetite to make them smaller by the administration. And so they're not giving Powell the fiscal support, which is part of the reason why the economy has not really slowed down in a meaningful way. But there is a shelf life on how long Jerome Powell is allowed to do that. So in the 1940s, to help manage interest expense and to work our way out of the massive debts acquired in World War II, the Fed was stripped of its ability to change interest rate policy. They had to lock rates. The front of the curve was locked at 0.38%. The 10-year was locked at 2.5%, and it stayed there for like 8 years. And the Fed wasn't allowed to do anything until the early 50s when we had the Fed Treasury Accord. Fed Treasury Accord. Go read about it. March 1951, the Fed and the Treasury agreed to separate government debt management from monetary policy, laying the foundation for the modern Fed. So Once we struck this accord, William McChesney Martin was like, listen, we've got to raise interest rates. Sorry, guys. I can't just sit by anymore. And so they agreed, through official policy to allow the Fed to have its independence again. But that was the last time the US had debt to GDP anywhere near what it is today. Now, we don't have the exact same economic setup for us to work out the problems in the same way that we did in the 40s. We probably won't. But the similarity is likely going to be that they will have to run GDP hotter than the debt, which means inflation likely running hot. Not 9%, but hotter than is normally comfortable. And that means the Fed needs to be neutered of continually fighting its mandates. And so one of two things can happen. One of three things can happen. Either they openly raise the inflation target, which is fraught with risks and is, in my opinion, they would be unlikely to do that until they are well away from any inflationary scare. Because if they raise the target while they are just hovering above the original target and never getting there, then they're going to have a credibility problem. So I doubt that one is the first choice, though they may move away from inflation targeting in the future or raise that target. That's one possibility. Another possibility is that they allow the Fed to continue trying to fight inflation, knowing that they're going to run large deficits anyway, and that it's not going to really do anything. And then they have a credibility problem again, a credibility problem with the central bank that they would have to try to work back into the psyche of market participants. And that's not a situation they want to find themselves in. So what that leads us to is the third probability, which is that they just take away the Fed's mandate to fight inflation. Say, listen, you're just going to have to put up with this for a while. We have 130% debt to GDP. You currently have us at 5% interest rates, and that just won't do, bruh. Look at our interest expense. Interest payments. Get it. We got to get this under control. And maybe we don't have to get it under control today. Maybe it doesn't need to be under control by Q2 2024. But maybe between now and when Powell's tenure is up in May 2026, they realize that shit needs to be fixed and that we can't have an independent Fed if we are trying to fix the debt to GDP fraction. So I think Powell can feel that coming down the road. He's been allowed to kind of set his legacy, but we're entering a period, and it's been building for the last few months, where the Treasury's taking over and the Fed is being clipped of its ability to really enact policy. And Powell's probably not going to want to be around to see the baton handed over for that, right? He's been able to run the Fed kind of the way he wanted to, at least outwardly, at least publicly. It's highly unlikely that they would use that same Fed chair to essentially have a new period of fiscal dominance, of complete lack of autonomy from the central bank. They would probably put a new guy in for that, new person in. That's my feeling. And so it really just kind of blew my mind yesterday watching that press conference, because it just seemed like Powell was totally checked out. He said, when he was talking about inflation, he said, we don't really know if this is a bump in the road or something more. We'll have to find out. Yeah? When's that, Jay? When are you going to find out if it's a bump in the road or something more? What data points are you going to need to see? How many more months of data are you going to need to see? When he was asked about the economy, he said, we think financial conditions are weighing on the economy. Really, Jay? What gave you that impression? Was it the... You guys can hear me laughing. He said, we feel that financial conditions are weighing on the economy. Really, Jay? What gave you that impression? Was it the secularly low unemployment rates that we haven't seen in 50 fucking years? Is that what gave you the impression that things were weighing on the economy? Was it real GDP of 2 to 3% with interest rates where they are? And then he said, yeah, the inflation data came in a little bit high, and I think it caused people to raise their inflation expectations. Oh, no shit. So when inflation comes in slightly higher than expected, people raise their expectations. I've never heard of this concept before. Please tell me more, Jay Powell, head of the Federal Reserve. And then I just, repeatedly yesterday, just saying over time, we will get there. The market believes we'll get there over time. And knowing that we've been hanging out here for 9 months, just going sideways. It seems like he's intentionally juicing us. And so when you hear that kind of thing, you know you're in a re-election year. You know that the current administration is running massive deficits. The other guy that you can vote for is probably also going to run massive deficits because both guys are populists. Biden and Trump claim that they are in different political parties. And I'm not going to get into political discussion here in that way, but from a high level view, there is just no discernible difference between the parties and the way they actually run the government. The only difference is in the topics that they have their mobs argue about. But the way they actually run the government is very similar. Biden and Trump are both populists. Much of our foreign policy has been identical to the way it was run under Trump in the Biden administration with small changes. And if we get, no matter which one of these old fossils gets elected in November, we are likely to have large deficits into the foreseeable future. Which means likely swallowing higher than target inflation for an extended period of time, which means that, inflation sensitive assets are likely to moon. So we've seen that. Look at gold. Gold's breaking down today, but gold has been rising, right? Look at the trend of gold, especially since October, when the markets really started taking off and when we found out Yellen was clearly willing to play some ball to help soften financial conditions as we headed into an election year, because she willingly provided slightly less duration to the market than they were expecting back here. And it kicked off a big rally. Gold has been leading that part. Bitcoin has also been going. A lot of people believe that Bitcoin trades with gold. I would argue it trades with tech, and tech has been running. Everything has been running. Everything that benefits from higher than normal inflation has been running. I don't know that it goes all year, that we're 24 hours removed from an FOMC. We still have slowing job growth on pace with past recessions, which I'm not going to dive deep into here right now. We'll look at some of that next week. But the labor market is showing signs of either being back to normal or actually starting to slightly weaken a bit. If you look at individual jobless claims state by state, they look a little suspect. If you look at unemployment state by state, it looks a little suspect. But on a national level, it hasn't really bled through on a national scale to really have caught anyone's attention. Some other elements of labor, like we've seen hires falling, right? Quits are falling, job openings are falling. And Powell cited these data points, all three of these specifically, as evidence that his work is feeding through into the economy, that monetary policy is feeding through into the economy. But I would suggest that all three of these metrics were abnormally high following the pandemic, and that they are simply returning to their means. Maybe they continue to weaken, and then we could say, well, maybe policy is too tight and that he needs to cut. But right now, he doesn't get to claim credit for any of this shit. But on a rate of change basis, it is concerning, particularly the rate of change of job growth itself. That is starting to slow down. We've looked at that a bunch. We look at it almost every stream. And so those things are still present. However, everyone still has a job. We still have 4%, 5% wage growth, and certain parts of the economy are picking up a little bit. Certain inflationary pieces of the economy are picking up a little bit. Today, we got our composite flash PMI from S&P Global. This is not the ISM manufacturing PMI that is often cited. It's a different group, but they run a similar kind of survey on another subset of businesses. And what they're showing is a pickup in the manufacturing sector, a pickup in the services sector, and inflationary forces returning. Inflationary pressure showed signs of picking up. Input costs rose at the fastest pace in 6 months, while firms increased their selling prices to the largest extent since April of last year. Inflationary pressures picked up in March. The rate of input cost inflation quickened to a 6-month high amid faster increases across both monitored sectors, services and manufacturing. In turn, companies in the US raised their own selling prices at a faster pace. The rate of inflation was the sharpest in just under a year and stronger than the series average. Respective rates of output price inflation accelerated across both manufacturing and services, quickening to 13 and 8-month highs respectively as companies passed through higher input costs to their customers. So we're starting to see that pick up a little bit. And I don't have do I have it in front of me here? I don't have my CPI chart up right this second to look at, but we looked, I think maybe 2 streams ago, at different components inside of CPI that are remaining kind of sticky and elevated on a rate of change basis. If you look at gasoline prices, don't look now, but gasoline is up 40% from December. That hasn't bled through into CPI inflation yet, but it will. Let me show you something here. Here is energy CPI. Let's look at this on a percent change from a year ago basis. What you can see, energy has been a net drag on the headline CPI figure, but as we see, gasoline is now up 40%. Oil is rising. Commodities generally bounced yesterday fairly decently. Not all commodities, but we see oil rising and we see gasoline up 40%. Like I said, it hasn't bled through yet, but we're already seeing the negative effects of energy dissipate. It's crawling back up to break even, and pretty soon energy could become a lift on CPI again, as we are sitting right here at 3%. If we look at it on PCE, which is the one the Fed cares a little bit more about. Where is it? PCE. Hold on. Let's see. Personal consumption, energy chain type. I have to find these energy goods and services. Here it is. It's always hard to find the specific one you're looking for. Let's put this one up. This is PCE. Same thing. Creeping back up. And we've noticed the actual prices are rising, but the feed through into PCE hasn't happened just yet, but it likely will if this dynamic continues. And with Powell leaning into the YOLO inflationary growth, I have to believe that that will happen, and that it's likely that a rate of change of headline inflation will probably start to pick up again. And then what does the Fed do? Yes, I see someone in the chat says the Fed adopted an average inflation targeting framework in 2020, and they tried to average 2%. And that's very true. But what does it say then when we consider that fact and we recognize that they have been above 2 since March of 2021? So they're not averaging 2% inflation. They're averaging whatever the fuck this is, like 4%. So for them to average 2% after spending 5 years above it, they would need to spend some time below it. Otherwise, their average targeting is failing. Let me go back in the chat. I got some questions I need to catch up with. Hit the likes, says Paul. Yes, smash the like buttons if you haven't already. Appreciate you all being here. Someone asked, what's the name of that breadth Momo indicator that I use in TradingView? This is my own proprietary indicator. Where is it? I have now lost the screen. It's proprietary to me. I built it. I have not shared it because it requires me to manually update the 40 names that are contained within it. And so I just didn't want to commit to doing that for a bunch of public consumers just yet. I'm trying to work with TradingView to see if there's a better way of making their indicators support more names. So right now I don't have these shared, but we'll look at them here together whenever they're relevant. Yeah, the crypto crandall talking about the inflation targeting. Yes. If a black swan in the next couple of months causes the markets to come down 20 to 30%, the Fed reacts by sharply reducing rates. Can a V-shaped recovery happen and we go up? I mean, certainly that's what we got in March of 2020. And so if they were willing to do something similar like that again, we could. And it would depend on what drove us down. So the crash in March of 2020 was because they closed the economy, right? Like the global economy just started shutting down left and right. One state after the other in the US announced they were doing lockdowns. Different, I think Italy started it off in Europe. A bunch of countries followed suit. And we just literally shut down half the global economy. And then we decided to rain money down upon them. And we had a combined fiscal stimulus and monetary stimulus. And those things combined are what put in the V bottom from March 2020. But it is also important to note that when we did this, inflation was 1.5%. The treasury market in this period of time went literally no bidless. There was the order book was empty in the treasury market, which freaked out people in the banking system, right? That's not the deepest and most liquid market in the world isn't supposed to do that. And it did in a dash for cash. The question then becomes, okay, well, we could put in a V bottom. Maybe we don't put in such a sharp fall. Maybe we just get like a 20, 30% thing. And then all of a sudden, the Fed's like cuts to zero and we moon. I mean, maybe that's possible. But I think what we'd really need to wonder is what would fiscal support look like in that moment? Is it likely that they will just rain another $2-3 trillion down on people if a bunch of folks lose their jobs? Like if we suddenly have 7% unemployment or something like that, which is about double what it is now, would that be enough? And it's not clear that it would be. It's not clear that it would be. Powell even said yesterday that, if there was continued strength in labor, that might not even be enough to get him to decide not to cut interest rates, right? They'd probably need to see an acceleration of inflation itself back to unmanageable levels, like above 3.5% or something. He didn't say that, but you'd probably need to raise 2 or 3 months in a row and look scary for them to do anything. They seem pretty resolute in what they're going to do here. And that makes me a little concerned because it just feels like there's a lot of back clapping going on. Like we did it. We achieved the soft landing. All the hard work is over. Let's moon, boys. Let's fund these deficits, baby. And I just don't know. I don't know that is going to play out the way they think it is, just because I've studied so many business cycles and I've seen so many negative outcomes that it shades my perspectives. I willingly admit that it shades my ability to see how we dig through this in a positive way. Look at the S&P. This is fucking absurd. Who takes over from Powell? The Trump administration floated a couple of names they would consider. Arthur Laffer was one of them. A couple of other people. I don't know who would replace him. They would just nominate somebody. I mean, Powell was already a vice chair, I think, of one of the banks, and he'd been on the board for a while. But before that, he worked at the Carlyle Group, which is like a private lender, in private markets. And so, I don't really know. It could be anyone. Who the fuck knows? I mean, it could be Steve Mnuchin. for all I know. The former Treasury Secretary. Just the same way that Yellen went from Fed to Treasury, Mnuchin could go from Treasury to Fed. I don't know. Need another TXMC and BCB collab, says Garlic Brad. Yeah, maybe we'll do one. We'll do one soon. It's I in the last couple of weeks, I have turned down a couple of requests to have me go on podcasts and things, because I've been hesitant to go and try to deliver like a forecast, because I'm aware that what I thought this market would look like has been different. And I'm aware that measuring economic momentum is not the same as measuring markets and price action. Those things don't have to go together. And so it's hard to know exactly how much we can really put up with this just up only forever. Is it a month? Is it 6 months? Is it 2 years? Is this just our life now? Do we not have any recession for another 10 years and we just continue to have up, and we literally like melt our money down into dust? I don't know. And the tough thing for me is that most of those scenarios, here's the tough thing. Many of those scenarios, those kind of YOLO scenarios, involve us making a lot of money as market participants. If you own Bitcoin, if you own the world's most scarce digital asset, borderless digital asset in a world of infinitely multiplying dollars, you're probably in a good position over the long term, right? It's why I own Bitcoin. It's why I have some that I will never get rid of. But seeing a scenario come where you anticipate yourself and others in the market making a lot of money doesn't wipe away what happens right after you make a lot of money in an irrational market move. A lot of people lose money right after that, and and people will lose money along the way through the economic destruction that we are partaking in order to manifest an outcome for asset markets. We're willing to destroy savers in order to pump our own bags. And, the societal malaise is rising. Young people are not interested in saving for retirement. They're interested in YOLOing in the markets and having experiences because they don't see the pathway that their parents and grandparents had to achieving stable, healthy wealth, right? They feel like they have to do it through gambling. And those who are too afraid to do that don't even bother. And they just blow their money on Birkin bags and fucking cruises and, buy now, pay later stuff. And you see this in multiple countries. I just saw a story this morning out of China. I think I tweeted it. And it was about how they have all this youth gambling at like record levels, like that they've never seen before. Yeah, here it is. Young Chinese eased their angst by playing the lottery. Ticket sales surged to 2008 levels, by the way, in the article there, while they have record high youth unemployment. Nations young face a tougher economic climate than their parents did. It's not just China, right? It's US as well. It's Europe. It's Japan. And so like, yeah, sure, they're going to juice things and maybe we make a lot of money, but is that really what we want? Like, how do I get excited about that? How do I come on here and say like, guys, we're going to make a lot of money and it's going to be great, but we're probably going to destroy our society in the meantime. It's going to be awesome. Watch that UNPL grow, baby, green candles. I can't look at it that way. I have a kid, I have a 10-year-old. And I worry about the world that I'm giving him, that I'm leaving for him. And there's very little that I can do about that. And that's not the world I want to be able to make money in. One where everything just screams higher because it's literally the roaring 20s all over again. That's what we're in right now. The roaring 20s. We have record low unemployment. We have economic growth pretty strong. We have markets at all-time highs. We have people, just with no concept of saving for the future. Everyone's YOLOing into the market. We got zero DTE options, setting new records on volume every day. It's just got grandmas playing meme coins on Solana. This is like late stage capitalism kind of shit. It reminds me of ancient China when they allowed people to cast their own coins. And what ended up happening was rampant inflation and people abandoning fruitful labor because more money could be made by gambling. And that story is told again and again around the world throughout the centuries, where we destroy our money to such a degree in an effort to get something for nothing. That is the story of human money, is our endless pursuit to get something for nothing. And we what we continually do is destroy the money to such a degree that people abandon the idea that they can live fruitful lives. And they feel like the only real way to get ahead is to participate in the circus, because the circus becomes the only show in town. And the pressure that places on people is immense. The effect that it has on the morale of a people cannot be quantified. The effect of bad money on the morale of a people. And I see us in the early stages of something that we've been laying the groundwork for decades. And it gives me more concern than excitement, even though I anticipate that my longs will benefit, my bags will benefit. I don't feel good about spreading that message, even right now, as I'm saying it, there's like another part of me that's like, man, that just sounds so bearish and negative. And like, it does, right? It sounds bad. It's not all bad. Like there's things to be, there's positives to be taken from everything. But if we're just talking about the trajectory of the US dollar, the economy, what we're doing to our money, the path of wealth creation that we are laying for our next generations to follow, it's all fucked up. Millennials are at 30% of the wealth generation that boomers were at this age. 30%. They have a third of the net wealth that their parents had when their parents were 40, and they're now 40. Is it any one? And housing affordability is literally the worst it has ever been. Is it any wonder why sentiment has not been great? Why there's such a divergence between the haves and the have-nots? We're literally making it happen because no one wants to make tough political choices, and we continually put people in power that reinforce that thinking, because no one wants to be the generation that actually has to eat the crow. We just keep thinking that we'll deal with it another 5 years from now. I just don't see how that ends well. Don't overthink it, guys. BTC is going to rip, says Brandon Hammond. I mean, it's been ripping. It's been ripping. Look at it. Does that mean it just goes up endlessly because of what we've been talking about? I mean, if it does, great. But every market, even the most absurd markets, they obey laws of physics eventually. Will BTC rip? Possibly. But it's up 350% off the low in 1 year, a little bit over 1 year. And from an on-chain perspective, it looks a little overheated. I didn't even get to this because I just got on my rant, but I don't know. I hope BTC moons. I hope BTC and gold moon in this scenario. It's very likely that they will do well rather than doing poorly. But I also worry that we are getting too excited by the money that could be made and forgetting that there are very real, very unresolved economic questions still percolating right now. All right. It's been an hour and 10 minutes. If you have not hit the like button and you've been listening to me talk, please do so. That's the best way for you to support the channel. We will do another members stream. Let's look at the calendar. 2 weeks from now, we'll do a member stream. Either the end of next week or the beginning of the week after, we'll do the member stream. Maybe we'll do it next week. I'll decide before then, and I'll let you know at the start of next week's stream or right before then. We'll do a member stream, so everyone has a green name in the chat. We'll get to hang out afterwards and just kind of shoot the breeze. I didn't look at the recession data today, like all the tables and things that I've built for that, because it takes up like a whole stream all by itself. So what I think we'll do is we'll book another one for Sunday or Monday, and we'll talk more about those kinds of things. You know, there'll probably be some rants from your boy because that's what I do, but I wanted to break up the data a little bit because when I try to cram everything in, it ends up being 2 hours. It's just too much. I see BCB in the chat. What's up, bro? Hope you're enjoying your vacation. Yeah, I saw you mention the Russell. Yeah, we're starting to see the Russell wake up a little bit here. Maybe some of the talk from yesterday is igniting a little bit of energy there. What we've discussed here on the channel is we have this structure here near the highs. We have this point here where it was rejected and made the new low, and that's where we are. So what I'd like to see, if you're a bullish small caps, you want to see structure building up here, right? Like I don't want to see just a wick and then it come back down. That'd be ugly, like another one of these. I'd like to see some actual structure up here. Maybe we get a breakout. Maybe the Russell goes higher. I don't know. Where is its next retracements? Let's see. Yeah, they're right up here. We're not that far away. So maybe it goes a little bit higher. It's really been struggling, but it's a long Wyckoff accumulation here. Now we're just kind of hanging out at the sign of strength area. Been waiting for small caps, but the thing about small caps is many of them are very inflation sensitive, and without large rate cuts, their bottom line is just simply not improving. So while there might be individual stories, certain companies that start doing better, and maybe with rate cuts, we see a broader improvement. But until we have a bona fide easing cycle on our hands out of the Fed, small cap businesses are just not in an environment that is suitable for them right now, that is supportive of their business models, because many of them are extremely debt reliant, as opposed to mega caps that are very cash rich. And that again is part of the haves versus have-nots. I did want to touch, I'll show one thing real quick before we go. There was something I showed about the Russell just the other day. And then we'll wrap this up. Where was it? So many things. Oh yeah. 63% of the Russell is red on the year, which is kind of impressive when you think about how the Russell, where did the Russell start the year? Well, I guess it's here. It's not really that green. It's only about 6% green, but 63% of it is red on the year. What has really been driving a lot of the gains are names up here. You see this column? This is how much these names have been responsible for lifting the Russell. Super Microcomputer. Look at that. That's about to join the S&P. MicroStrategy. Carvana. Abercrombie. Like these are the kind of names that have been lifting the Russell, but the vast majority of them are down on the year. 1,200 are down on the year. Breadth could be coming back, but it's too early to say. If we look at it on the NASDAQ, I'll show you real quick. Look at it on the NASDAQ, stocks above 20-day, 50-day, 200-day moving averages. We're still chopping around here. It hasn't really recovered, I would say. But neither really has the NASDAQ. Let's see what happens next week in regards to that metric. But momentum for the NASDAQ, here's the momentum. This metric here, this momentum breadth Momo for crypto, this is it for the NASDAQ. You can see it's just been sideways. So breadth has not been expanding on this leg here. It's been holding steady. Hoos donated. Thank you so much, brother. From the members of Crypto GB, your analysis is greatly appreciated. Thank you, Hoos. Hoos is an OG buddy of mine. We met at Bitcoin Conference 2022, I think. Very nice guy. Brandon Hammond gifted a membership. Thank you so much, my dude. Chris also gifting a membership. Chris in Akumal. I hope I'm not fucking that up so bad. Too bad. Both gifting memberships. Very generous. Thank you, folks. My voice is really sore, so I'm going to wrap it up here, or else I'm going to have to start drinking water every 5 seconds. So let's summarize kind of thoughts here. Inflationary pressures have been picking up. We have noted that inflation has remained above the Fed's target by a full 1% since June of last year and doesn't appear to be going lower. And that is happening with inflationary pressures rising, which we saw in the PMIs. And if you look at certain components inside CPI, they are also showing the same things. We're seeing gas prices up 40% just in 2024. That hasn't yet bled through into energy, but is likely to at the current rate. And despite all of these things, Powell doesn't care. He doesn't seem concerned, because they released their projections yesterday. They raised growth, they lowered unemployment, they raised inflation, and they kept the same amount of cuts. Now, they pushed out a cut or two 2 years from now, a year from now, but that almost doesn't matter because this year looks the same, even though they changed all of their other figures. And so that's positive for inflationary assets on the margins. You know, with all else being equal, that should be a positive for gold, for Bitcoin, for raw materials, for other commodities. That should be positive for those things. Will that continue? I don't know. Many of those assets are already up so much. Bitcoin's up 350% in a year, and certain metrics are starting to trigger that we're near the cycle highs, though we don't have to have actually top ticked it just yet. And, you know, we're still watching a pretty strong economy, though rates of change in certain parts of labor are concerning. It's pretty clear that the recession is not the number one risk now. The number one risk now is overheating on a reacceleration. That is now the biggest risk. Not as of yesterday. Maybe recession risk has not been number one for the last couple of months, though we've been watching it pretty closely because this is a sweet spot when things surprise the market. And so we could absolutely get surprised by a credit event or something of that nature. Something geopolitical could surprise us. But economically, the economy isn't about to just fall off a cliff. In fact, it actually looks relatively strong. It's just that labor is slowing down so much, and there is so much pressure on labor to sustain economic growth that it makes it a really precarious type of strength. It is clearly economic strength, but because credit growth has slowed so much, incomes really are the strongest leg of the stool for the economy right now. And so anything at all that disrupts the strength of the labor market is a risk to US GDP, and like an immediate risk, because income growth is the engine of this cycle. So we watch incomes closely. But right now, like I said, because Yellen is playing her games in the background, because Powell seems to kind of be dismissing getting inflation to target, and because we're in a year with large deficits kind of booked, it seems like they're willing to risk a reacceleration more than they are willing to accept this trade-off. So, because for a long time, we had been thinking that there would eventually be a point where they would have to decide a trade-off between growth and inflation. And it seems that they're willing to just put up with this. They don't have to actually raise their target in order to just continually float above it and deliver platitudes every 6 weeks about how they're data dependent. They could probably carry this on for a couple more meetings. And that creates an opportunity for those inflation sensitive assets to do well. So we'll watch. But I thank you all for being here. I am just one man on the internet. These are my personal opinions from my own personal research. I do not manage other people's money. This is not a signal service. Please take this all with a grain of salt and do not put your money at risk without educating yourself about what you're investing in. We will meet again in a few days. I haven't decided if we'll do Sunday or Monday, but I want to do another stream where we focus not on BTC and the stock market, but we look at some of the other economic stuff and loop that in with what we've been thinking about the Fed and all of that. So keep your eyes out for that. And then we might have to do a member stream at the end of the week or something, because I'll be out of town the first week of April for a few days. So I don't know if we can do it then, but we'll see. So, until the next time we meet, take care of yourselves, friends. Take care of each other. And we will chat again in just a few days, a very short few days. Cheers, everyone.